Hello, everyone, and welcome to SBSB's latest webinar. Today, we're going to be talking about stock investing and some major pitfalls that are important for investors to avoid. My name is Joe Simko, and I'm a portfolio analyst at SBSB, and today I'm joined by my good friend and colleague, Stephen Gasparini.
Hey, everybody.
So we always like to kick these things off with some trivia, so here's today's question. If you invested $1 in each of the following asset classes in 1802, over 200 years ago, and held the investment until the end of 2019, how much money would you have? When we do the live presentations in January, I usually like to poll the audience to see what kind of responses we get, but unfortunately, we don't have that luxury with the webinar. So I decided to conduct a very unscientific survey of 5 of my friends to see what they thought. So for gold, the responses ranged from $2 all the way to $69,000. For bonds, the responses ranged from $7 to $23 million, and stocks ranged from $30 to $500 million. So there's a lot of different answers out there. Let's see what the right ones are. First up, though, is cash. And as you guys might know, over time, the dollar tends to lose value because of inflation. So if you had $1 of cash in 1802, it would only be worth about 5 cents today. Next up is gold, which would be worth $4. Gold has historically been a good store of value over the long term and a good way to fight against inflation, but the returns aren't too impressive. That brings us to bonds, which would have earned you a little bit over $2,000. So now we're handily beating inflation and earning a nice return. And finally, stocks, which would be worth almost $1.8 million, by far the highest return. Now, I'll add that this wasn't smooth sailing. If you know anything about history, going back to 1800, there's been a lot that's taken place. In fact, in America alone, there have been 1.3 million soldiers that died fighting 9 major wars. There have been 34 recessions that lasted a cumulative 49 years. The stock market fell over 10% from highs on over 100 occasions, and it lost a third of its value 13 times. We've had 30 major natural disasters that killed over 400 Americans each. Even what we've seen so far in 2020 isn't unique. In 1918, the Spanish flu pandemic estimated to kill about 50 million people worldwide. And in this time where all of this was taking place, stocks still turned $1 into almost $1.8 million. Now, it's not very realistic that anyone could benefit from 200 years of stock returns, but we wanted to show you this to demonstrate the phenomenal long-term performance of the stock market. And that brings us to today's topic, which is exploring some of the common pitfalls that prevent investors from really benefiting from the full potential of the market.
Thanks, Joe. Great point. Stocks generally go up, but unfortunately, that's not necessarily the case with all individual stocks. And in our line of work, we've been exposed to some pretty famous last words. Things like, it's a sure thing. Oh, this stock has been all reliable for me. It's going to be great for hundreds of years moving forward. Or this really popular idea is definitely going to be a profitable idea. And while it may be the case, history has shown us that there are a lot of examples where these lines don't always hold up. And I'll kick us off by running through an example of old reliable. So let me set the scene. The year is 1994. The Cranberries just recently released Zombie, and you're really psyched about that. But you're also excited about the Christmas bonus you're expecting this year. And after all the Christmas expenses, you have a few $1,000s, and you want to throw that at something that will participate in the stock market, but also just be there. You don't want to have to think about it. And when you think about something that's been there forever, back in 1994, that's film, that's cameras, that's Kodak, right? So with that in mind, you invest a few $1,000s and you think that you're about to set it and forget it for the next 100 years, until all of a sudden, digital photography hits you out of nowhere, and film photography takes a massive hit. And that's okay, right? It's this new digital photography thing. I'm a long-term investor, film's not going anywhere. And then they actually throw digital cameras into phones. So, this is a new development, but again, it's only been a few years. What could possibly go wrong from here? And then Apple comes with the final blow and delivers iPhones to the world in 2007. and pretty much putting the nail in the coffin there and making photographic film obsolete. So the real message here is just because it was there the last 100 years doesn't mean it's going to be there for the next 100 years. In fact, it probably means that it's likely about to be changed just based on the way that the world is working.
Yeah, that's absolutely right, Stephen. And I think it's worth pointing out that this wasn't obvious back then. It may seem so with the benefit of hindsight that film was going to become obsolete, but it's not like anyone knew that back in the 1990s. So that first risk is investing in an industry where the product becomes obsolete. But to continue to explore how hard investing is, let's look at one of the most transformative areas in history, the automobile. So let's say it's 1900 and you are confident in cars. You think cars are the future. Back then, again, that wasn't obvious. Stephen and I found some old newspaper headlines from the late 1890s, and one in particular stuck out to us. It reads, "Horseless carriage, a motor trap for 5." Back then, people were terrified of cars. And not only that, but there was massive pushback from the horse industry of all things. So today we can think of the very powerful taxi lobbies fighting against Uber and Lyft in America's major cities. Back then, it was the very powerful horse industry fighting against the car makers. But despite these challenges, you're confident in cars and you decide to invest in them. Look at this chart showing the number of cars in America from 1900 to 1925. You can see it was exponential growth in the early years, and that continued on for many decades. So with such a successful industry, you would think that that would certainly be a great investment. The answer is probably not. This is one of my new favorite Wikipedia pages. It's called The List of Defunct Auto Manufacturers, and it shows all of the American car companies that have gone out of business. And I'll point out quickly that this is not even the first half of the alphabet. Between 1900 and 1950, of the 3,000 car companies to exist in the United States, by the end of that time period, only 3 of them controlled the entire industry: Ford, General Motors, and Chrysler. So an investor in 1900 with all of these companies to choose from, you had a 0.1% chance of picking one that eventually went on to win. 2,997 or so of the 3,000 companies ended up being bad investments, and people that put money in those ended up losing most, if not all, of their money.
I mean, okay, Joe, so the automobile industry was a pretty great example, but is this really something that we have to worry about? Are there any other glaring issues in this realm?
Well, Stephen, let's look at another example. The plane also transformed transportation, and it's another one of the most important innovations in American history. This chart shows the growth in air travel from 1950 to 2012, and you can see that, like the car, the plane industry experienced tremendous growth. But that didn't make airlines a good investment. The airline industry has a history of being hyper competitive, which is great for consumers who want low airfare, but it's not great for investors and the businesses themselves. If we move on, we can see the performance of the airline stock index over the last 25 years. Investors that put money in 1995, they would have lost money to the present date. In fact, airlines have been such a persistent poor performer that renowned investor Warren Buffett famously bashes them from time to time, and this is one of my favorite quotes he has on the matter. "If a far-sighted capitalist had been present at Kitty Hawk, he would have done his successors a huge favor by shooting Orville down." So these companies have been great for consumers and they've transformed the world, but they have not been good investments.
So we can't just blanket invest into an entire industry. We're going to have to dig through the weeds and find that diamond in the rough. So what if we actually do that, right? What if we narrow it down to 2 or 3 stocks, or maybe that one sure thing within an industry that's absolutely going to take your portfolio to new heights? Well, when I think about great examples for sure things, Enron immediately comes to mind. And for those who don't know, Enron was an energy, commodities, and special services company that was headquartered in the United States back in the 80s, 90s, and for a brief stint in the early 2000s. They were a pretty regular company for the first 10, 15 years, and then all of a sudden their profits skyrocketed, and investors couldn't help but notice. Retail investors were all over it. hedge fund managers were skeptical until Fortune magazine had named Enron the most innovative company for 6 consecutive years, right? So suddenly we had real investors were on board with this too. And I think that was solidified even further by the fact that actual employees at Enron were putting their entire life savings into Enron stock, right? So we've got crazy profits, almost unbelievable profits, and we've got a lot of institutional backing on this stock. What could possibly go wrong? So it turned out all of that extra reported profit really was too good to be true. Upper management had been lying about profits for the last few years, basically just to surge their stock prices so they could sell attractively, leaving institutional and retail investors in the dust. So this sure thing actually ended up ruining a lot of people's portfolios and set them back quite a few years from an investment perspective.
So let's look at another example where it seems like it's too good to be true, but it is true. Cisco is a technology company that makes networking hardware, software, and telecommunications equipment. In early 2000, Cisco was the most valuable company in the world, with a market value of over $500 billion. And if you look forward from that point in 2000, the company continued to be a fantastic business. As you can see here on this slide, Cisco gave investors exactly what they were looking for: better revenue growth and better earnings growth than the overall market. But despite its bright future, Cisco was not a good investment in 2000 because the value was simply too high. It should not have been a $500 billion company. And if you look at that same time period, the total return you earned in Cisco stock was negative 42.3% compared to positive 141% for the overall market. Hopefully these 4 examples demonstrate how hard it is to find the right investment. You can invest in a tried and true company like Kodak, only for its product to become obsolete. You could correctly identify a transformative industry like the automobile industry or the airline industry, but you could end up not picking the right company or just getting general poor performance. Or you could find that diamond in the rough, the perfect company, but still end up losing money when it turns out that Enron is committing fraud or you paid too much for Cisco stock. So we've heard many investors throw in the towel on trying to pick individual companies or even certain industries because it's simply too hard. But there's one more common pitfall that Stephen and I hear from time to time, and that's the idea that spreading your investment across one country is enough. This slide here shows the Japanese stock market performance from 1988 to the present, and as you can see, investors in the late 80s and early 90s are still underwater today. There was a massive asset bubble in Japan in the 1980s, and prices got pushed so high that investors earned now 30 years of negative returns. But we don't want you to think that this could happen just in a minor emerging market country, or it would never happen in a major country, because Japan's stock market in the late 80s was the largest stock market in the world. That's not to say that we think this is likely to happen in the United States anytime soon, but it's a risk that investors need to be aware of. Plus, if you only concentrate your investments in one country, you're going to miss plenty of great businesses that are located overseas.
So we've made it through our list of pitfalls, and while nerve-wracking, it's important to remember Joe's early slides where we do see that stocks do generally go up. So while we do have to be cautious of these things, there are plenty of remedies out there that should help you navigate the stock markets just fine. So our first recommended remedy, this helps us avoid the Enrons of the world, the Kodaks of the world, the Ciscos of the world, and that's really just limiting your concentrated stock positions. So not having too much of your portfolio invested into one particular stock. And we've given a very relevant current example right now. Seen in the news, Hertz used to rent cars, but now they're just very famously bankrupt. And we have 3 portfolios that have some exposure to Hertz, in varying degrees. Our first portfolio is a 100% investment in only Hertz stock. Our second portfolio has a 10% concentration in Hertz, but then a fully diversified stock portfolio accompanying it. And then we have a portfolio with next to no Hertz exposure and just invested in the broader stock market. So year to date in 2020, how are we looking? 100% Hertz is down almost $900,000 if you had invested $1 million at the beginning of the year. Now, that drastically changes when we limit that concentration to about 10%. And we're looking at a lot of loss, but definitely much less. And we're only down about $73,000 year to date. And if we had kept our money completely diversified, that perfectly diversified portfolio is actually rewarding us with about $80,000 year to date. And market conditions are looking good for the year end. So now we've avoided our individual stock biases, but now how do we avoid the next automobile industry or the next airline industry? And the easiest way to do that is just to diversify across sectors. And it's never been easier to do that. You can pick an ETF or a mutual fund that invests specifically in different sectors if you'd like, or you could do something even easier and just invest in a broader index like the S&P 500, which has exposure to all of these sectors. So you can see here, if you don't have the winning sector, you might not hit a home run like technology has been over the last 10 to 20 years, but you're also not going to hit any losers like energy has been for the same amount of time, right? You'll always be right in the middle. And as you get older or as you progress in your investing career, we're going to discover that winning more is important, but it's also really about losing less.
Yeah, exactly, Stephen. So if you avoid concentrated stock positions and if you spread your money across different sectors, you're going to be able to avoid the first 4 pitfalls we discussed today. And the last step is to diversify internationally. So this chart here shows since the mid-70s, the rotating leadership between US stocks and international stocks. We have stretches of time like the late 70s, the late 80s, or the mid-2000s, where foreign companies have outperformed US stocks. And then you also have stretches where the US companies have won. The 90s is a great example where the US stocks had a long stretch of outperformance. The other thing you'll notice from this chart is that it's cyclical. After a long period of outperformance for international stocks, that tends to lead into a period for US stocks when they do well, and vice versa. And over the last decade, it's been a great period for US stocks. So if history is our guide, that means looking forward, it might be a better environment for those foreign companies. Now, you may have noticed that Stephen and I haven't really given you guys any specific investment advice because there are some legal rules on giving advice to general audiences, but I will just say that if you look at the industry average, they say to have between 1/3 and half of your portfolio, of your stock portfolio, invested in foreign stocks.
So to quickly summarize, we know that stocks can be good for our portfolio, but at the same time, they can also be very hazardous. Fortunately, we can avoid these hazards by limiting our stock concentrations in the portfolio, diversifying across sectors, and going global.
Yep, exactly. And if you do these 3 things, you'll tilt the odds in your favor so you can really benefit from the full long-term potential of the stock market. Thanks everyone for joining us. We hope you enjoyed and we'll see you next time.
Thanks everyone.